Dear students, good morning. I am starting a new module, a series of lectures, Basic Financial Accounts. This is module 1. Now, see, when we are talking about the financial accounts, final accounts, two statements are very important. One is trading and profit and loss account, and second is the balance sheet. Now, what is the connection between these two statements? See, these two statements, we prepare information based on trial balance, or we take details of trial balance to prepare both these statements. So that is the connection. Now, which all items from trial balance will go to trading and profit and loss account, and which all items will from trial balance will go to balance sheet. So if you want to learn this, we have to distinguish between capital expenditure and revenue expenditure, capital income and revenue income. So that is what we are going to do. So let us explain what is capital expenditure. See, what you mean by capital expenditure. As a business unit, if you're making an investment where you are expecting the returns for more than 1 year, then we call it as capital expenditure. See, for example, if you're purchasing a fixed asset, if you're purchasing a vehicle, land, machinery, patents, copyrights, all these are examples for capital expenditure. So, purchase of fixed assets, expenditure in connection with purchase of fixed assets. See, sometimes you have to remember that when you are purchasing a fixed asset, as it is, you cannot put it into use. Sometimes you have to construct a platform. Sometimes you have to install a transformer. Sometimes the electricity wiring has to be changed. So all this related expenditure will be there. That all we will include in as a capital expenditure along with that machinery which is purchased. Now, expenditure for extension or improvement of fixed assets. Say, for example, if you have a semi-automatic machine, you are converting it into fully automatic machine. That meaning it's a capital expenditure because the benefit you're going to get for a number of years. Architect fees in the case of construction of building is a capital expenditure. Expenditure incurred to acquire rights like patents, copyrights, trademarks, all these are examples for capital expenditure. Now, what are revenue expenditure? Revenue expenditure, you have to remember that these items will go to trading profit and loss account. That whereas capital expenditure, we are taking it to the balance sheet. So, revenue expenditure is required for the day-to-day working of the organization, the day-to-day running of the organization. That meaning you have to remember that electricity charges, salary, that water bill, or insurance what we have taken for 1 year. All these are revenue expenditure. So, revenue expenditure includes day-to-day expenses, upkeep of fixed assets like repairs, renewal, purchase of stock. Because only by selling stock you can get revenue. So, purchase of stock in the case of business organization. But if it's a service industry like bank or insurance, you have to provide service. That is how you will get the revenue. Now, depreciation for upkeep of fixed assets, that is a revenue expenditure. Depreciation, you have to remember that we are using the fixed asset. Purchase of fixed asset, we have seen that it's a capital expenditure. When you are using the fixed asset, you are charging depreciation. And this depreciation you will set aside because when you want to replace the asset after the useful life of the asset is over, you will be able to purchase the asset with this fund. That is the idea of depreciation. So that depreciation is also a revenue expenditure. Now let us see the difference between capital expenditure and revenue expenditure. In the case of fixed assets, capital expenditure is acquiring, owning, purchasing a fixed asset. Revenue expenditure is if a fixed asset is maintained for the day-to-day working, then it is a revenue expenditure like repairs, renewals. Earning capacity. Purchase of capital asset will increase the earning capacity, whereas revenue expenditure, it will not increase the earning capacity. It will help to run the business organization. Now, benefit capital expenditure, the benefit will get for more than 1 year, whereas revenue expenditure, it will get only for 1 year. Financial statement, capital expenditure, we will take it to balance sheet. Revenue expenditure, we will take it to trading and profit and loss account. Now, what do you mean by deferred revenue expenditure? This is very important. See the term revenue, deferred revenue expenditure. Deferred meaning it's delayed or extended. So, I told you capital expenditure, the benefits you are going to get for more than 1 year. Similarly, there are some revenue items also where you will get the benefit for more than 1 year. That is called deferred revenue expenditure. So now what are deferred revenue expenditure? The preliminary expenses for setting up of the business. See, for example, that advertisement campaign they have to do. They are installing a service or introducing a new service, and they have to prepare various documents. The preliminary expenses for setting up the business. These are all revenue expenditure. Then brokerage on issue of shares and debentures. You know that the business firm, when they are raising the shares and debentures, they have to give commission for the financial institutions which are helping them in raising funds. That is a deferred revenue expenditure, because the benefit of that finance or the funds you acquired, you're going to get for a number of years. Then advertisement expenses. Advertisement expenses, you know that how MNCs are all spending their funds for advertising. Huge amount they will invest. So advertising expenses is a deferred revenue expenditure. The benefit you will get for a number of years. One advertising campaign, when MNCs will change, or any business unit, when they will change from one to another, brand ambassador will be changing. It's a huge expenditure. Now, if we have to distinguish between capital expenditure and revenue expenditure, we have to distinguish between capital receipts and revenue receipts. So what is capital receipt? Capital receipt is revenue obtained from sale of fixed assets. When you're purchasing a fixed asset, it is a capital expenditure. When you're selling a revenue or a fixed asset, it's a revenue receipt. Sale of investments. See, business organizations will have various investments, maybe it in bank, government securities, stock market investments. When they will sell, when they are in need of money, they will sell. Or when the stock market price is improving, they will sell that. That meaning it is a capital receipt. Issue of shares and debentures for raising funds. So when they are issuing shares and debentures for raising funds, it is a capital receipt. Now you have to remember that these items will go to balance sheet. Now you have to remember what is revenue receipt. Revenue receipt meaning income earned from sales. You know that business organizations can make profit only by sales. Or if it's a service organization, they have to provide service. That is how they will earn the income. So income earned from sales is a revenue receipt. Now dividend or interest received. Dividend received from various investments the organization has made, or bank interest or debenture interest. These are all revenue receipts. These items will go to the credit side of the profit and loss account. Or if the business organization has got a building to let out, it will be a revenue receipt. So the commission earned. See, when a bank, when they are selling insurance products, insurance company will pay them the commission. So it's a revenue receipt, because for a bank, the main activity for the bank is the banking activities. When they are doing some subsidiary activities like selling insurance products and all, they will get commission. So that will go to the credit side of the profit and loss account. That is a revenue receipt. Now you have to remember that revenue receipts are taken to profit and loss account. Capital receipts are taken to balance sheet. This is what I want to explain with this module. Thank you.